All right, welcome to another episode of the Credder Podcast. I'm your host, Chase Palmieri, and with me today is Jason Fishman. He's the co-founder and CEO of DNA, which stands for Digital Niche Agency. He's also the host of the Test Optimized podcast, where I was recently a guest, and so we're doing a little back and forth crossover here because the conversations are just too good and both communities need to hear about them. So, Jason, thanks for coming on to my podcast today.
My pleasure. Agree on the conversation and have been looking forward to continuing it in this forum to your audience.
Yeah, and your agency specializes in a very interesting niche, uh, pun intended, which is helping companies reach and crowdfund from what you might consider non-accredited investors on these equity crowdfunding platforms. So why don't you give us a little bit more detail into kind of what you would, how you would frame that up?
Absolutely. So my career started in ad tech. I started a growth marketing agency. We were servicing startup to mid-market organizations and found fundraising to be a common theme. Hey, can you work on the marketing section of our business plan, pitch deck, first campaign that we can show the results to an investor to scale and get more capital? Can you even participate in the investor meeting? So when I was introduced to a legal filing, Regulation D 506C, which allowed for solicitation to accredited investors, the light bulb went off because suddenly we were able to use our digital marketing skill set to effectively fundraise for our clients. Later, Reg CF, Regulation Crowdfunding, and Regulation A+, which allows for much larger raises, as you said, to both retail and accredited audiences, went into effect. To date, we've worked on over 400 of these investor acquisition campaigns that have collectively produced 9 figures of capital. So fell into it, saw success, built case studies, were introduced to more of these issuers, companies issuing stock on these FINRA regulated platforms, and have become a go-to group in the space. I get to speak on the topic regularly, and yeah, always looking to share insights about how we reach these premium audiences and the type of metrics around it.
Yeah, and we talk a lot about fundraising and especially how that fundraising environment can shift underneath founders at any time, whether it was during COVID or with rising interest rates, for example. Times are sometimes easy. Money can be, maybe never easy for a founder to fundraise, but liquidity can help at times. But then when that liquidity comes out of the system, it really is on the founder to market their raise in ways that reaches the right people with the right stage that can write those checks to keep the business going. So I do want to take a little step back here. I think most of our listeners will know what an accredited or a non-accredited investor is, but just for us to kind of tee this up, why don't you explain the accreditation rules as they existed and kind of what Reg CF allows for that is now different?
Sure. So I was taught at that time, accredited investors, it's 200K individual income for the past two taxable years or longer, 350 household, or $1 million net worth outside of your primary home. You have to go through a KYC process that stands for Know Your Client. It's a standard at a bank, investment bank, fund to get a better understanding of your financial history, financial status, and groups that are bringing on accredited investors have to make sure every investor goes through KYC, which is not always straightforward. As you could imagine, there's a lot of different factors that could actually make someone who thinks they're accredited not be accredited, and vice versa. Regulation crowdfunding went into effect in May 2016, and it's designed to democratize access to investors from founders, as well as deal flow for retail investors and allowing them to participate in early stage rounds for private companies that could have massive growth from their valuation. It levels the playing fields in many regards, and it can be smaller investments. There's a platform called King's Crowd, which provides the analytics for all of the FINRA regulated portals. It shows where campaigns are at in real time. They also do great studies. And they found in 2023, the average investment was a little over $1,100. So, it may take, let's say, 1,000 investors at $1,000 average each per $1 million raised. But Reg CF as of May 2021 allows for March 2021 allows for $5 million per campaign year. You can do a simultaneous accredited investor raise, a Reg D, and get to higher amounts. Reg A plus, Regulation A plus, allows for up to 75 million. So it's real capital that can be pushed through this, and digital allows for scale again. So once you crack the code in terms of investor acquisition, hey, we're reaching these audiences, this is our cost per click. Once we get traffic there, here's our conversion rate, here's our cost per acquisition of each investor, here's the effective return on ad spend. You can ramp it up and scale it up and hit much larger levels and bring on more than just capital. I mean, it's ambassadors in many cases that show up. You could bring in user owners, and whether they're customers, whether they're clients, watch your actual fan base turn into shareholders, and all on one seat of the cap table, depending on what it's structured. So you're losing less control. Everyone's working off the same terms, the same valuation. So I hear a lot of these benefits from the founders that we work with. We're on the marketing side to make sure there's enough investor traffic going through the funnel.
Yeah, and the intention, I should kind of, as a side note here, the intention of the accreditation requirements was meant to protect the unsophisticated investors from, pumping their life savings into a company that is maybe a high risk startup. Because as we know, startups are risky. Returns are rare, but when they do happen, they can be really outsized returns. And so it's true what you said about this leveling the playing field. I thought for many years that this was the low-hanging fruit win for people who were out there talking about the wealth gap and this kind of discrepancy between upper middle class one percenters and lower middle class. And it just this always seemed to me like a no-brainer. We live in an age where anybody can research companies, get access to the same metrics, learn how to become an investor through reading books or listening to podcasts, and that these accreditation laws were essentially almost like a moat that was keeping only wealthy people able to continue investing in an asset class that had outsized returns. So that's a sidebar, but I was very happy when Reg CF came out. Obviously, your business is kind of founded on taking advantage of this new wave of entrepreneurs and founders that are going directly to not only everyday people, but people that it could theoretically already be their customers too. So allowing customers or partners to actually buy in and own a piece of the business. So let's start there. These folks that are actually writing checks through these platforms, should we think about these as grandma, grandpas? Should we think about these as young people who are speculating and trying to get ahead? I mean, I'm assuming that you have to create some kind of a demographic on these folks before targeting them. So how do you think about these types of investors? Are there some big VCs writing checks through this medium? Yeah, give us a breakdown.
Absolutely. And as you said, they were outdated laws that went into effect in the 1930s when there were door-to-door salesmen selling grandma,
Snake oil.
land in Florida. Yeah, snake oil. I think things that didn't exist.
Yeah.
There is a lot more available to us today in terms of education. We're in the information era. And as a result, they modernized how groups could raise capital and using digital channels, offline as well, but digital. These tools are very effective at gaining awareness, nurturing, engaging, and it's across the board. We do see campaigns that the targeting, 55, 65 and up is producing the strongest cost per acquisition, cost per purchase of the shares. We see campaigns where it's much younger demographics and platforms like TikTok moving the needle. Test, optimize, scale. That's my motto, right? So we have assumptions going into a campaign. We have a strategy process where we're putting together audience personas, but we need the data to show us what's working. We need those variants, the A/B tests, looking for pockets of performance and optimizing towards those, looking to provide clients avenues to scale. So
sorry,
yes.
just to jump in there. So
Yes.
what you're saying is you have enough time from the beginning to the closing of that campaign to actually be A/B testing throughout. It's not that you feel like you
Yes.
have to come in with one set strategy.
That's correct. Uh, 3 months is a starting point on many of these portals, and they'll allow you to do extensions from there. The filing is good for 12 months. So depending on when you go live, it can easily be a 6, 10 month longer type initiative. And as you know, the traffic is really just to audience test. So we can then look at what's happening in real time on some of these social advertising platforms. It's light daily pacing, and as we're seeing some performance optimizing towards that a bit, and maybe considered inconclusive data. In all fairness, in more of a programmatic landscape, but enough to make optimizations and see real results. These audiences with this messaging, with this funnel is producing. We're going to do more of that. And then there's a closing period that creates a real fear of missing out. And we see a lot more action in the final weeks, the final days, as that time to invest is closing.
And one of the downsides that I think these platforms actually turned into an upside is something you mentioned earlier, which is that all of these investors actually come in under one seat on the cap table. So when I was first looking at how this was going to work with these platforms, that was one of my major concerns because the more folks you have on your cap table, the more folks that you're really responsible for and communicating with. And yes, you'll have to communicate with these folks that invest through these equity crowdfunding platforms, but to then in a future round, take your cap table to a VC and they see hundreds of names on a cap table, that could become a mess. And so I really do think that this was a big win that these platforms and this legislation was able to turn all of that into basically one name on the cap table. So that's you've mentioned some of the upsides. What are maybe some of the downsides in raising money from this class of investors? Do you have to expect a lot more back and forth with maybe uneducated investors or people who maybe have unrealistic expectations on the timeline or the level of returns?
Yeah. Well, as you said, there's many upsides. There are investment banks, there's accelerators that participate in these deals. They'll be an anchor investor and then use the platforms to amplify and bring in far more of the retail investors. Y Combinator, different accelerators routinely launch on these platforms. And where it was a stigma years back in the early days of equity crowdfunding of, oh, this is a deal that couldn't get funded at the VC level, so they're taking it online. We
Right.
are seeing more positive interactions at this stage of, hey, we were able to bring in 5,000 investors and bring $5 million to the table and substantiate this valuation and the use of proceeds. We're able to take us to this next level of growth. That's a very strong story when looking at additional capital partners in the future, in later rounds. It can still work against you. So I would start the list there as, presenting it to the wrong parties could still have some backlash. The first thing that would come to mind, though, at the top of that list would be it's a lot of work. So, where some founders can make a few calls and close out a full round, and I know that's not the case for most, this is heavy lifting. If you have a significant audience, you can funnel them to the campaign through organic channels and likely see a strong turnout. But I'm a data guy. I'm looking at King's Crowd and those analytics and do a report weekly for my team, do larger webinars to study, 2023 or Q1. And the top 10% of campaigns are really moving. We're here in April 2024, March. The top 10% all raised 200K or more for the month. The top 10, 600K or more for the month. In March. The bottom 50%, it was under $9,600. So half of the campaigns are really not raising much. And they're also putting in work. I mean, you have to do in many cases, financial audit. You're bringing in a legal team, financial auditor, maybe working for Portal or a broker dealer. There's all of these partners in play to get your campaign live. Then it's not, if you build it, they will come. You have to drive the traffic there. You have to have headline worthy announcements and a content calendar and distribute on a regular basis to showcase momentum and demonstrate, hey, this is a moving ship. It's your opportunity to hop on board with us, and we're going to hit these destinations. But some groups have a much easier time at that than others. And you really need the crowd effect. There's a saying in venture capital, if everybody wants to be first to be second, meaning, hey, this large investor came in, I'm going to hop in now. Crowd effect, but with much larger numbers here in digital, where, hey, if there's thousands of investors, your campaign is going to do very well, but it's an uphill battle to get to those first milestones, 100K, 500K, a million. Only 7% of the companies that used RegCF, 7.46%, data guy, hit seven-figure amounts of the 1,434 that launched in 2023. So it's a massive undertaking. When successful, not to just hop back to the good, you can continue using these vehicles for your next rounds. There are ambassadors that come out of it. As mentioned, I've seen franchise opportunities. I've seen merger and acquisition activity. I've seen all different types of publisher relationships, well beyond the capital. So you could continue using these systems to do more and more and more, but you do have to crack that code first.
Yeah, and it's one thing that's interesting that I just want to highlight there is that these platforms, they do have the right to refuse you using their platform. There really kind of is this invitation or acceptance or due diligence process that they themselves do before they'll let you launch on their platform. And then I guess theoretically, you could imagine that a equity crowdfunding platform like the WeFunders of the world, and I will ask you to maybe we'll talk about the different platforms and where you think is best to run a campaign in today's day and age. But
Sure.
theoretically, on these platforms, you could come with a solid team and an idea and maybe a concept video, and you could raise money and you could actually show that capital raise from a wide range of individuals. You could use that as kind of the validation or early validation of a concept that you could then follow up with a VC or an angel group and actually raise a larger amount of money. Is that, in your opinion, though, too early to try to use these platforms? At what stage do you prefer to actually take a company to these platforms?
Sure. Well, the majority of groups we work with are in planning or already live on one of these platforms. So there are scenarios where, hey, I'm leading a workshop, more of marketing growth, and I get asked afterwards about which platforms to use and coach founders into one of these fundraisers. But in many cases, we're referred, we're contacted about a live campaign, and therefore are very focused on the marketing discussion. If I'm speaking to a prospective issuer, the first question I'm going to ask is, how large is your audience? Because if we're building the audience from the ground up, it is a different scenario than if they have 200,000 email addresses, people that they are distributing content to regularly. So I want to ask about the audience. Some of the platforms require you to have revenue and certain amounts of revenue. They want to push deals to their audience that they believe are going to be successful. So they have different KPIs, different key performance indicators that they want to make sure you're currently seeing. So I've seen early stage, I've seen growth stage companies use these vehicles. I've seen early stage companies succeed. I've seen them fail. The same true with companies that are much further along, and even groups that have 100 physical locations, brick and mortar, not do well. When I've seen others, one mom and pop, one brewery, one retail store do fantastic, just outstanding results. So I wouldn't say there's one particular profile that fits. I do look to see how proactive the founder and the team are, because the content creation all the way throughout, creating that excitement, that buzz, getting individuals to believe in you and where you're steering the ship makes a huge difference. So I believe King's Crowd said of the early stage companies, 13 million was an average valuation. across all companies, including the growth stage companies. 39 million was an average valuation in 2023. Just to paint a bit of a picture, the only way to measure is with numbers, just giving you some metrics here. But I've seen solopreneurs succeed at this, and I've had question marks on how they're going to, and just a very strong audience response. And I've seen companies with celebrities, pro athletes, sharks fail at it.
Hmm.
So to me, it's more about the execution.
Yeah, no, that makes sense. And so name a couple of these platforms. You don't need to name them all. I know there's
Sure.
more popping up all the time, but maybe name the top four or five and how you would kind of think about where you would want to launch if you were in the position of one of these founders.
Well, I'm friends with all of them. So I wouldn't break it down to just one as much as which is the right one for a specific group. The top two, based on how much is raised, is our Start Engine and WeFunder. Start Engine has about 60, 65 campaigns live at a time, right? In 2024. WeFunder over 200, 225-ish. Next would be Republic and Net Capital. There are other platforms that weave in and out of that 3 to 5 spot. Dealmaker is a self-publishing platform. They give you tools to launch on your own site. They're constantly in that 3 to 5 range as well, and they have some very large campaigns both on the Reg CF and Regulation A plus side. Self-publishing is a whole nother world where it's just your campaign showing up on your site, or a funnel that you build, versus being live on these other portals. And I could talk for hours just on the pros and cons and the right times to launch on self-publishing. Republic has some very specific verticals. They have a whole crypto side, Web3 to their business. So groups can do very well there if they have a blockchain component. Net Capital, 50, 60 deals live at a time. And you can really stand out there when you're succeeding, where you could be one of many groups on a platform with more deals live. So there's about 90 FINRA regulated portals. So many of those with only a few deals live. If you're doing well, you could get a very strong percentage of their investor base to participate. So there's pros and cons for each. I would speak to the top five, all of them: Start Engine, WeFunder, Republic, Net Capital, Dealmaker, and based on your interactions, learning about their program, learning about their contract terms, make the decision for who you feel is going to support you the most and where you can see the most success. Because you really want to stand out and be a feature on their site, not be difficult to find on any of those platforms.
Right, because they can help pop you up and surface you. And as a campaign is getting more momentum, they I think have all these kind of gamification things where they can move higher up in featured feeds and things like that as well.
Correct. They do have to treat each issuer the same, is
Hmm.
the brief note I'll add to that, per SEC guidelines. But yes, if you're being featured in their email newsletter to 1 million investors, it's likely you're going to see a spike in investments in the following 24 hours.
And am I right to assume that you can only choose one platform at a time, that you can't be running, raising 300K on WeFunder and another 250K on Start Engine and combine those? How does that work?
Well, for each filing, there's different components to it, but most commonly, Reg CF, it's one platform at a time, and you can move to the next and reach a new investor base. You could stay on that platform for your next round and really get a stronger sense of connection to their investor base and see more of them come in, especially if you have new traction, new updates. Regulation A plus, sometimes it'll be self-publishing, and then portal deal. We've worked on campaigns with side-by-side Reg D, side-by-side Regulation A plus campaigns, and drive traffic to a landing page that then directs to different funnels. But you do want to focus on one location, even if it's that first landing page, and really dominate there.
Okay, and typically fundraising before, the crowdfunding really came into prominence was a seasonal thing. You better close that check before the investors leave for their summer vacation and before Thanksgiving and Christmas time and holidays. So technically there's a slightly different type of investor that's writing checks through these platforms, but do you still see some of that seasonality? Would you recommend a certain time of year to either avoid or try to be launching?
It's a bigger question for reward crowdfunding because you're looking at a 30, 45-day run, where in equity crowdfunding, you could be live for the full year and
Mm,
therefore see hills and valleys throughout the year. Uh, some years, December has been the top month where that would never be, guessed. It wouldn't be common in the venture capital community. Uh, we've seen strong spikes during the big five with Black Friday through Cyber Monday,
mm,
and again, kind of dead in the investment banking space. Meanwhile, more of a almost an e-commerce play with stock conversions happening in equity crowdfunding. I would say it's the same is not true every year for any given month. So it's a matter of your campaign, what you're rolling out. There's always going to be external factors. If the stock market takes a dip, it could reflect investor behavior, certainly if the economy does. Then again, when the retail investor revolution, as some would call it, occurred during 2020, and the Robinhood app got record number downloads and just more activity as a whole. So did alternative investments in private equity, including equity crowdfunding, and with varying stock conditions. If there's announcements of war or global events that could affect the economy, that could reflect your conversions for the day, for the month. We saw different dips in 2022 accordingly. So that there's so many different factors at play. Time of year is important, but you want to look at how to maximize that time of year and how to continue if it's working, but you haven't hit your full goal yet.
Okay. Yeah, that makes sense. And how do you all think about perks or rewards? Whether that's something as simple as stickers or, a coffee cup with the company logo on it that you promise to the first so and so amount of investors. How do you think about tying the perks in to really rile up the community?
So perks are how Kickstarter and Indiegogo, work. The rewards, they're not a constant in equity crowdfunding. That being said, they can absolutely motivate investors. If there is a strong incentive for them to participate at $500, when the minimum may be 100, 300, it could be 500, but a strong incentive that could get them there, or they're able to meet with the founder, with the founding team. Maybe it's a celebrity team. If they put in 2,500, 5K, 25K, there are different disclosures you have to make about your income and or net worth once you get over $2,200
Hmm.
as an investment, really across your investments on Reg CF for the calendar year. But I've absolutely seen perks to be popular, and some companies are better at it than others. Should absolutely be explored.
And obviously, you can't work with every company that you see on these platforms. So, what do you see as kind of the most common mistakes that these other companies that maybe didn't have you in their corner are making? Just maybe a couple of the easy to have corrected, but they just didn't know better mistakes.
Sure, not enough traffic and not impactful enough messaging. So I envision 50,000 visitors on a Reg CF per $1 million raised, which speaks to a 2% conversion rate with 1,000 investors participating at $1,000 average each. I will see issuers with 3,000 visitors to their offering page saying it just doesn't work, when really they didn't drive enough people there and it didn't average out at the end once the closing messaging hit. The impactful messaging component, it's got to be exciting announcements, got to be a wealth of third-party validation featured throughout the content. And there's excellent recommendations on all these portal sites. WeFunder has a playbook. Start Engine has marketing recommendations. They all do, and they all host different webinars and pieces of content. I've ran workshops with them to their issuers about what to do and how to leverage your community channels, social media, email, having webinars regularly, town halls, Q&As, articles, having other publishers talk about you, getting featured in investor email newsletters, and not depending on any one thing as much as having a strong marketing mix. Some of these groups don't have a marketing plan or strategy towards how they're going to hit their goal. More of a let's dip our toe in the water, see what type of investor response we get, when really you're just launching a website. You still need to get traffic to that website, even if it's hosted on a bigger platform. So not enough traffic, and really striving for meaningful messaging.
Yeah, so basically takeaway being the whole kind of if you thinking that if you build it, they will come. That's it doesn't apply to product, it doesn't apply to getting customers, and it definitely doesn't apply to equity crowdfunding as well. So yeah, ultimately it
Correct.
does come down to the execution.
Yes.
Yeah. Okay, so we covered the upsides, we covered the downsides, we talked about what types of folks are doing this. One of the other downsides that I had heard from professional investors when, this idea got kicked around once or twice with Credder, because we have kind of this community and crowdsourced model as well. So, it's come up at times that, well, why don't we do a raise by turning this over to our user base? One of the potential downsides that I want to talk about now is this idea of a campaign not reaching its goal and that looking like a black eye as that page kind of sits up there SEO optimized, because search engines are giving WeFunder and Start Engine really high priority in their search results, that this page becomes like a black eye that basically shows a company's inability to reach their fundraising goal. Whereas in traditional fundraising, you see a lot of people, they start out and they say, oh, I'm going to raise 2 million. They go out, the market's not as interested as they thought, and then they quickly lower the number on their seed round deck to 1 million. And then in the end, they end up closing something like 500,000 and they book it as a win. And nobody really knows that they didn't actually meet the performance goals that they had in mind from the outset. Whereas with this live campaign, it sits there as a black eye. So tell me kind of, I'm sure it's happened before. What happens when a company of yours does not meet their goal? What can you do to help?
Sure. So I'm on the marketing side. There are many considerations when determining whether you should run an equity crowdfunding campaign or not. And I can give ideas, I can give my perspectives from the marketing lane, but there's a lot of things to look at. For us, if we're able to show a positive return and they're effectively able to raise capital, it's usually ending at a pretty decent spot. However, yes, if you raise, $30,000, $180,000, and are positioned as a company that's going to disrupt a vertical, that can work against you. If you're looking at crowdfunding fundamentals, reward or equity, you want to make sure you're going to be able to have a strong turnout. With reward crowdfunding, and we focus on equity crowdfunding, but I take from fundamentals there because that's where this was all spawned from. You want to make sure your first day produces a minimum of 1/3 of your external goal. You can have a larger internal goal, and that's the result of a pre-launch campaign. With equity crowdfunding, different portals offer different approaches towards pre-launch. You can do a test the waters campaign. That's an SEC term, where you can be taking reservations and may not need to disclose how much has been raised, and then determine whether you want to go live from there. Some platforms such as WeFunder have a soft launch mode, where again, you don't need to list how much has been raised. So once you hit a substantial enough amount, you can take it to public launch stages. You may have some limitations for marketing leading up to that, but you can rally and make sure you're coming out of the gate strong enough. During those periods, you can bring in pre-existing investors, friends, family, first degree networks. It could be a strength in numbers, a couple hundred people, $1,000 average each. Is very possible for most people. I mean, it's low minimum amounts, some higher investments, some larger stacks of chips on the table from other people that and you can get to a good baseline, and then market and look to scale it up from there. Ultimately, with business, there's successes and failures, and you need to be able to talk about your failures with learnings and what you were able to take and take from that experience and grow from there. It may not be brought up ever. It may not be brought up on a regular basis, but you would want to be able to explain why it wasn't a good fit and why you went to other locations for capital. If it's that next move, that next capital discussion, that may be difficult, but it should get easier and easier as you're able to close out your next rounds offline. I've seen groups with marginal campaigns relaunch and have top 10%, top 1% raises. So sometimes those learnings are applied towards the next round. But again, digital allows for scale, and once you find a winning scenario, you can keep ramping it and ramping it and ramping it up. So there may just be something off about the offering. Could be a list of 100 things. Valuation, the product market fit, it could be many different things, but determining what that is and being able to shape the next steps accordingly. There's an inherent risk with marketing. There's an inherent risk with fundraising. Many founders have told me the VC markets have really slowed down over the past year or two. When I look at comparative stats, activity has dropped and activity has been stable and or picked up in the same periods in this vertical. So I still look at them as very powerful tools, but they are tools. They don't guarantee success.
Yeah. So why don't you share with us one of your actual success stories, and maybe if you're able to actually name a company and tell us kind of what made that campaign so successful.
Sure. There's many to point to. We had one that wrapped on Friday, mid-April here, for Circles. That's with an S, and they're a review platform similar to Yelp. They're a Yelp competitor. They would call themselves a Yelp killer, and it's a platform based on positive reviews versus negative. And they could speak at length about all the holes for other review platforms and their advertising programs and how they remove positive reviews. Short run campaign, and produced 2.35 million, and heavily from their own existing user base. Had some media partners, a radio host in particular, that kept pointing towards the campaign. They held some different presentations as well for investors, and we ran advertising, and saw over a 13x return on the pixel. And it's a rising tides lift all ships. I would not say it's one marketing tactic as much as a combination of everything. But when we were able to scale into those ads and drive more traffic and do more retargeting, we saw it lift and lift and lift. And I think their founder, John Worthington, their CEO, who's been on my podcast. He was part of a panel that I hosted with 3 other clients last week as well, all with multiple 7-figure raises. It's his proactiveness, his passion around the product, his experiences that led into that, and why he dedicates his time here that really resonated with the audience. So, as I mentioned earlier, with the traffic, meaningful updates, and in their case, community, media partners, they were able to see strong success, and it's not the first time they've done it.
Very cool. Yeah, I'll have to check them out. I always, as a founder of a review platform, I always like to see review platforms going after new verticals or just doing it with a new approach. So I'll definitely have a look.
Absolutely. And we have many other case studies, listed on our site, my podcast, interviews, many hosts on that same topic. How did you do it? What worked? What didn't work? What would you recommend for founders? That's just a very recent example. I have another campaign that's a 1 week campaign that's doing very well right now that I thought would mention. I wanted to mention the most recent, but just thought it'd be a good opportunity to give a shout out and point out Circles, who is doing great things.
Yeah. Why don't you actually take this moment to give listeners a few places online where they can get a hold of you or learn more about what you're doing?
Sure, sure. So very accessible on LinkedIn, Jason Fishman, DNA. You can reach out to me and my team and I through our site, digitalnicheagency.com. Can listen to Test Optimize Scale. I have video on YouTube, and then anywhere you enjoy your audio podcast can tune in there as well.
Okay, great. And we'll definitely have all those links in the show notes for people listening. And so, Jason, now we're going to turn to the last two questions. I gave you a little bit of warning, but I didn't tell you what the questions were. But we end every podcast asking these two questions. So, first is Bitcoin. Do you have any thoughts on Bitcoin? Are you a believer? Are you a skeptic? Do you have not enough education on the topic to even have an opinion? Where are you at with Bitcoin?
We started working on digital asset campaigns, investor acquisition, user acquisition in 2017. I've spoken at cryptocurrency conferences in 8 countries. I am a big BTC fan. I encourage friends, family to build themselves a digital wallet with blue chips as well as alternative coins, follow the right signals, get the right alpha, have the right strategy, not buying just to buy, steer away from day trading. I do have friends that are very successful at swing trading that I point others to. And I believe that decentralized currency is the future. It is a store of value that is free from different nations' governance and towards a white paper, towards a strict code to ensure safety on both sides. I believe the platforms are going to become easier and easier. The access is going to become easier and easier. And through every dip, there is a rise. Recent podcast interview around an educational platform, all around 2033, is breaking down all of the different patterns, and it's almost calculated at this point the ups and downs and how to anticipate what's coming accordingly. I don't think anyone knows exactly, but I think anyone who said it was a fad or a scam was wrong. The largest institutions in the world are either directly invested or closely watching it and participating at these conferences. I've talked to them firsthand in many cases, and we live online. Why wouldn't our money, why wouldn't our monetary assets be digital?
Very well said. And I actually don't usually share my thoughts on the subject, but you did make me think of something here as it ties into the conversation we were having earlier. So with something like Bitcoin, where you do have this hard cap, the supply cap of 21 million that can't be printed, as compared to government fiat money that can be printed and, in large amounts when there are things like pandemics or debt liabilities, interest on our $34 trillion of debt, for example. Um, what what this means when money gets printed is that it's disincentivizes savers who are holding cash, right? Because
Yes.
your cash is becoming worth less. Not worthless necessarily, but worth less and less. And so what that actually does is it pushes everyday people with everyday jobs to basically become professional investors and to speculate to try to create a return for themselves that outpaces inflation, just to keep the money that they already worked for. So
Yes.
I see this trend mixing with crowd CF or reg CF. And to me, it makes perfect sense that the amount of everyday investors investing in startups through these types of platforms is only going to increase, increase, increase as inflation becomes a greater and greater narrative and more people realize that they can't just hold cash under the mattress because it won't be there when they need it for retirement. It won't be around when they want to pass it to their children or their great grandchildren and whatnot. So To me, I
Yes.
see you sitting at the front of a really interesting wave that capitalizes not just on this new legislation and the door opening to these folks, but also a backdrop where everyday people do have to get in the market and become speculators just to keep the money they already worked for.
And we're spoiled here in the US, even with constant fear of the dollar collapsing, and it's seemed imminent over the past couple of years. Other countries have it much worse,
Right.
and even peer-to-peer transactions are extremely complicated. They're not dependable. So globally, it's an even stronger need. And I like your perspective on turning everyone into an investor. I haven't heard it put that way before, and I think it's very accurate. And financial literacy, the education around how to manage a portfolio puts us up against each other. And yes, it's a store of value that I believe is going to become more and more mainstream. We're already seeing it in terms of how it can be used, how it can be stored long term, and the popularity is only going to grow from here. I mean, it's being taught in high schools, colleges, across the board. It's going to be second nature to younger and younger generations, even if older demographics age out of it at different times. But yeah, strong believer in BTC.
Cool. Yeah, same here. So going a little further out of left field here now, maybe I'll set this up a bit. We're seeing the digitization of everything, information went from books to now you can get that information from a Google search. Um, Video games went from Pong to now super realistic three-dimensional spaces that you can experience and hardly differentiate from everyday reality when you have on, the new Oculus or Apple devices and headsets. And the acceleration of this technology, it's clearly improving at a very fast pace that, the improvements we've seen in just the last, call it 20 years, if you scale that out another 200 years, it is more and more obvious that we will have digital realities that are increasingly it's increasingly difficult to perceive the difference between that digital reality and base reality. So lining that up, my last question for you today on the podcast is, are we living in a simulation?
I feel like I'm on the Joe Rogan podcast
A
here.
little bit, a little bit.
Elon Musk would say there's less than 1 in a billion chance that we're in base reality.
Right.
So I don't have the answer to it, but I think about these things. I think it's intellectual curiosity for us too. And yes, it's becoming unrecognizable already at times what to believe in the media. That's why I think Credder is so great, and being able to determine credibility of different sources as an agency, being able to determine where to advertise. We're going to reach real people who engage with actual content. And if I look 10 years out, if I look to 2050, there's going to be some stronger guidelines put in there. Otherwise, we're just all going to believe in falsities. So could everything around us just be a construct of a simulation? Absolutely. What does that mean? Has everyone entered through your actual vessel and they've been and it's happened trillions of times, and it's how someone plays out in that simulation? Are we being harvested for something larger, and we're at this stage in our evolution? Who knows? But having an understanding of code and how that shows up in DNA and how this shows up here, there's so many questions to our universe. And you could go down a conspiracy theory rabbit hole. They say many conspiracy theorists die unhappy, and that's because we may never know the answers. We may be bees in a hive, not conscious of a world, other continents outside our little area. So I think it's fun to speculate about. With my understanding of digital, I think it's 1,000% possible, and definitely believe that we'll be creating those virtual worlds ourselves within the time spans that you're speaking to. And it's unknown. The unknown can be scary. Who knows what's to come of AI? And if AI becomes, leadership, they talk about AI religions and AI dictators that can't be killed off. So I think it's very fascinating, and we'll all be figuring out little pieces at a time together.
Well, thank you for indulging me and speculating on the nature of reality for a bit. And obviously, thank you so much for coming on the show and giving listeners a really thorough walkthrough of the pros and cons of equity crowdfunding, the best practices, and of course, most importantly, your contact information so that any founders or entrepreneurs who are considering this can reach out to you. I'm sure even if they're not live and they're just thinking about it and they want to kick the idea around a bit, I'm sure that they can send you an email and reach you through the website. So Jason, thank you again for your time today. This was super fun, and best of luck to you and the agency.
Absolutely. My pleasure. Thanks for having me on. It's been a pleasure to speak with you, Chase. And yes, anyone who's listening, please feel free to reach out.